Good day, friends. CEV Group welcomes you for watching this video. Please do not forget to like, comment, and subscribe our channel Registered Values Club, and you will be getting all new professional updates. Of course, all these updates will be free of cost. So, in this video, we will discuss some of the case studies based upon income approach, and these case studies are special case studies which you might not have uh, till now discussed, and we will now try to discuss some certain case studies which are very important from practical point of view and as well as from examination point of view. So we will try to learn certain things which are very important for income approach. First thing which is very important is how to find value of a going concern. That is the most important things. So here what we have to do, see, first thing is you must know what is going concern. Going concern is that which is still in production and is producing certain profit. That concern is called going concern, and its value is also calculated on the basis of profit. So let us take an example. The details of an industrial property is as follows. The market value of the building is 2 crore. Replacement cost of machinery, etc. less depreciation means depreciated value of the plant and machinery is 60 lakh, and working capital is 40 lakh, and expected annual profit is 24 lakh. If the reasonably expected return is 12%, find the value of the property as a going concern. See here, you have to find the value of the property as a going concern. So how we can proceed in this case? And second thing, he has ask you to find the value of the property as a going concern if the expected annual profit is 39 lakh. In the first case, expected profit is 24 lakh, and in the second case, expected profit is 39 lakh. So see here, you have to find out the value based upon these two things which are given to you. Means you have to find the value of a going concern based upon annual profit, which is 39 lakh in the second case, and in the first case it is 24 lakh. And second thing you have to keep it in mind is expected return, which is given to you as 12% in this question. So this is given market value of the land and building is given to you as 2 crore. Replacement value of the cost of machinery and set it is given to you as 60 lakh, and working capital is given to you as 40 lakh. So total is rupees 3 crore. You add all these three things, the value will be 3 crore. And next, he has given you expected annual profit. First, in the first case, it is expected profit is rupees 24 lakh. Now see, investment is 3 crore and expected profit is 24 lakh. It means return from the business 24 lakh divided by 3 crore means we are getting 8% return from the business. If the expected annual profit is 24 lakh, it means the return is 8%. But in the question it is given that expected return is 12%. Hence, what we have to do in this case, if the return from the business comes out to be less than the expected return, then what you have to do, you have to reduce these two values so that expected return is at least 12%. If it is less than 12%, we have to reduce these two values, 2 crore and 60 lakh proportionately. So what we will do, we will reduce these values, so ceiling figures, this is called ceiling figure. Ceiling figure will be revised downward as the value. What we will reduce? We will reduce it with the factor which is 8 by 12. So see here, this is expected return. 12 is expected return and 8 is the return which you have been getting if you are getting an expected annual profit of 24 lakhs. So we will multiply this value as this total value as 3 crore with a factor which will be 8 by 12. So we will reduce this factor. So see here, reduced ceiling value will be 3 crore will be reduced to ceiling value. See, this is called ceiling value, which will be 2 crore instead of 3 crore. So now out of this 2 crore, you know, working capital is remains 40 lakh. It cannot be reduced. So working capital is 40 lakh. It means the going concern value will be 1 crore 60 lakh. So see here, reasonably expected returns will be 24 lakh is the expected return. It is now this return is over instead of 3 crore, it is on 2 crore. So you will be getting 12% returns. So thus the property can afford to substantiate the value of 1 crore 60 lakh as an integral part of the value in this case. So ceiling figure. So in the second case, expected annual profit is given to you as 39 lakh. Ceiling figures still it is 3 crore which is given in the example. And as you see here, your return here is 13%. Instead of now, in the first case it was 8% if the expected annual profit was 24 lakh. Now it is 13%. So it is above 12%. So you need not to reduce the ceiling value. So ceiling figure will remain as 3 crore. So out of 3 crore, 40 lakh is the working capital. It means the value of the going concern value. It will be equals to 2 crore 60 lakh. So in this case, in this way, you can find out the value of a going concern from the profit, expected profit and expected return if it is given to you. So if you can, now we can do certain MCQ on based upon this. What is ceiling figure? Ceiling figure, you know, it is working capital plus market value of the land and building plus depreciated value of plant and machinery. This total is called, the total figure is called ceiling figure. Next question is, while calculating value of going concern, the value of land is, what is the value of the land? Value of the land is the book value as per company record. You have to remember this thing when you are calculating value of going concern. You have to take the value of land as book value as per company record. Then for next is, while calculating value of going concern, the value of the building is, you have to take for value of the building, you have to take depreciated book value of the company record as per company record. So what is the reduced ceiling figure in this case? We have calculated reduced ceiling figure. If the return is 24 lakh, it will be 2 crore instead of 3 crore. So what is the percentage return in this case? You know, in this case percentage return is 8%. So what is the going concern value? What value is 1 crore 60 lakh which we have calculated. So if the expected annual return instead of 24 lakh it is 39 lakh, then the value you will know it will be equal to 2 crore 60 lakh. Next thing you have to do, see here how you have to relate usable FSI with encumbrance factor. This is the important things. So most of the times we ignore this thing, encumbrance factor, while calculating usable FSI. So in this example, we will try to relate to these two things, encumbrance factor and the usable FSI. So work out the encumbrance factor and the value of usable FSI from the following particulars of the property. Land area is 533 square meter. Total built up area is 205 square meter. FSI, permissible FSI is F1, means 1 is to 1. Rate of construction is 25,000 per square meter. Expected rate of land is 12,000 per square meter. Expected yield is 9%, and usable carpet area is 110 meter square. Prevailing rent on carpet area basis excluding local taxes is rupees 310 per square meter. So this data is given to you. You have to find first thing, you have to find encumbrance factor. So encumbrance factor means on how much land the total built up area is has been constructed, and means what is the useful, what FSI has been used while constructing this total built up area of 205 square meter. This we have to calculate. So in the first case, the yield is work from investment point of view. You know, cost of construction area of the building is 205 square meter. The rate of construction is 25,000 per square meter. So the value of the construction comes out to be 21 lakh, sorry, 51 lakh 25,000. So cost of FSI used, you know, 205 square meter is the covered area, and it means if this covered, for this you need land. So land rate is 12,000 per square meter. So the value of the land for FSI use will be rupees 24 lakh 60,000. So the total value, total cost will be 51 lakh 25,000 plus 24 lakh 60,000. It will be 75 lakh 80,000. So if you calculate the yield at 9%, so yield will be 0.09 into 75 lakh 85,000. So yield will be, yield will be approximately 6 lakh 83,000. And suppose now, suppose 205 FSI for 205 square meter has been utilized in constructing the structure for fully exploiting the land, so that maximum return on that investment made can be explained. So if you calculate annual yield, so rent per square meter is given as 310, and carpet area given to you is 110 square meter, and this is rent per month, 310 rupees per month per square meter. It is given. So annual rent will be, you have will multiply with the number of months. So annual rent is 4 lakh 9,200. Now see here how the encumbrance will be calculated. So deduct usual outgoings. So let us suppose usual outgoing is 1/6 of the gross rent, which is 4 lakh 9,000 2,000. So 68,200 is annual usual outgoings. So net annual yield will be 4 lakh 9,200 minus 68,200. Annual yield is 3 lakh 41,000. So encumbrance factor is 3 lakh 41,000 divided by 6 lakh 83,000, which is which you have calculated. So the encumbrance factor is 0.5. It means that 5 encumbrance factor comes out to be 0.5. Second thing you have to calculate. So see here, land is 533 square meter, out of which 205 square meter has been constructed. It means remaining area is 328 square meter. So usable FSI, so see there, so you can use 0.5%. The encumbrance factor is only 0.5%. So value of usable FSI, if you have to calculate, it will be encumbrance factor, which is 0.5 multiplied by the land rate per unit, and remaining area which we can use for construction, that is 328 square meter. So value of usable FSI comes out to be rupees 19 lakh 68,000. So now we will discuss some MCQ based upon these calculations. What is the cost of FSI utilized? We have calculated it to be 24 lakh 60,000. What is the yield at 9% on the basis of FSI utilized, which we have calculated as 6 lakh 83,000. If Third thing, if FSI is fully utilized, what is the estimated annual yield? We have calculated 4,09,200. In case the FSI is fully utilized and usual outgoing are 1/6 of the annual yield, what is the estimated annual yield? We have calculated it to be 3,41,000. If FSI is fully utilized, what will be the value of encumbrance factor? We have calculated it as 0.5. Then what is the value of usable FSI? We have calculated it to be 19,68,000. So these type of questions you can get in IBBI examination as MCQ. A building, next example, a building stands on a freehold plot of land measuring 650 square meter. The rate of land is 3,000 per square meter. The owner gets a gross rent of rupees 20,000 per month from the building. The estimated future life of the building is 15 years, but it is expected to be extended by another 16 years if the structural and other repairs costing rupees 1,20,000 are immediately carried out. The total amount of the outgoings is equals to 20% of gross rent. Find out whether it will be advisable to spend the above cost of repairs from an investment point of view. Assume the rate of return 7% on capital and 4.5% on redemptions. So this type of question you may get in your uh, practical life also, and as far as from a IBB examination point of view. So gross rent, per annum 20,000 per month into 12, 2,40,000, and so 20% is outgoing. So 20% of 2,40,000, it means amount of outgoing is 48,000. So net annual return will be 2,48,000 minus 48,000, 1,92,000, and cost of land 650 square meter multiplied by rate of land 3,000 square meter, 19,50,000. So YP for 15 years, for the first 15 years at 7% on capital and 4.5% on redemption, YP dual rate comes out to be, if you calculate it, is 8.47. So the value 8.47 into 1,90,000, 16,26,240. So the present value factor for at 3% for 15 years it will be 0.64. So the value of land which is 19,50,000, which we have to get after 15 years, its present value you multiply with 19,50,000 with present value factor 0.64, it comes out to be 12,48,000. So the total value of the property will be 12,48,000, which is value of the land plus plus value of the building of 16,26,240, which is capitalized value 16,26,240. So total value is 28,74,240. So this 12,48,000, it is the deferred value of the land. So see here we are assuming certain percentages which if you are doing certain examination questions, these values will be given, but in these examples we will be assuming certain percentages which may not be given in the question itself. So if if no repairs are carried out, it means the value of the property will be 28,47,74,240. But see here, if the repairs are have carried out immediately, so the building can remain, its economic life will be increased by another 16 years if uh, the immediate repair of 1,20,000 is carried out. So the instead of 15 years, so now we will be calculating YP at 31 years. So YP for 31 years at interest of 7% and 4.5% for redemption, the value comes out to be 11.7570. So YP dual rate will be 11.70 in this case. So value, capitalized value 1,90,000 is the net rent multiplied by 11.7, it is 22,46,400. So present value of land, present value factor for at 3% for 31 years, its value will be 0.4. So the value, deferred value of the land will be 0.54 into 19 lakh 50,000. 7 lakh 80,000 will be the value of the land. So the total value of the property 22 lakh 46,400 plus 7 lakh 80,000. So the value is 30 lakh 26,400. So see here in the first case value was 28 lakh 74,000 approximately, and now the value comes out to be 30 lakh 26,000. So this value, if you see the difference is 1 lakh 52,160. So this value you will receive, this higher value you will receive if you are spending an amount of 1,20,000. So by spending an amount of 1,70,000, you will be still getting an amount of 1,52,160. So it will be advisable to spend immediate repairs. As a matter of fact, the ideal amount for immediate rate in this case would be, so if you can spend up to 1,52,160 at this, uh, if you are spending this amount, you will be getting no profit, no loss. But if you are spending this amount 1,20,000 immediately, you will be still getting a profit of 1,52,000 or enhancement in the value of the property by an amount of 1,52,160. So it will, if the value is 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 more than, so ideal, this is 1,52,160 is ideal figure, so it will not be advisable to carry it out immediate repairs if the value is more than, if the cost is of repair is more than 1,52,160. So what is the gross rent? We have calculated 2,40,000. What is the net rent? We have calculated it is 1,22,000. What is the value of the property without repairs? Without repair, it is 28,70,240. What is the value of the property without repairs? Oh, sorry, with repair, it is not without repair, it is with repair. It is 30,26,400. What is the ideal amount which you can spent for immediate repairs? It is 1,52,160. So whether it will be advisable to spend the above cost of repairs from an investment point of view? Yes, it is advisable, as we have already discussed. Next question is, a property consists of basement, ground and first floor and stair cabin. The plot area is 600 square meter. The built-up area of each floor is 200 square meter. The basement and the ground floor are rented on lease to a bank at an annual rent of 2,65,020. The lease period is 5 years and can be further extended by terms of 5 years at the option of lessee. The lease period of 2 years has already expired. The first floor is occupied by the owner and the net fair annual letting value may be taken as rupees 20,000. The title of the land is disputed, and because of the proposed widening of the road, it is not possible to construct the second floor. The permissible FSI is 1. Work out the value of the property. So see here, this is certain portion, each portion is unoccupied and certain portion is rented. So as we already know, in case of income approach, a rented portion of the property will be kept calculated value valued by income approach method or capitalized method, and owner occupied portion you can use any method, but here another thing you is given to you as net and fair annual netting value is given as 90,000. So for the owner occupied portion, you can use this value and capitalize this value to find the value of the owner occupied portion. So for the purpose of valuation the property, we are divided into two portions. First portion is property A, which is rented, and lease period is 3 years, but sorry, 5 years, out of which 2 years have already passed. So the unexpired lease period is 3 years, and annual rent is 2,65,020. So allowing, let us suppose outgoings are 45,020. We assume this to, so the value, oh sorry, the annual rent, net rent comes out to be 2,20,000. So these are just assumptions. So otherwise, these things will be given to you in the question if you are doing it from IBB examination point of view. So we'll divide it into three parts. First, 3 years, which is unexpired period of lease. Second, for the next 3 years, if it can be extended as given in the question, and for the remaining period in perpetuity. So we will calculate the YP accordingly for the first 3 years, then for the next 3 years, and then for the remaining period in perpetuity. So we will be doing this question because it is no data is given for enhancement of rent for the any period after first 3 years. So we assume the rent will remain the same for throughout the life of the building. So no data is given, we will assume it to be same for it remains to be same throughout the life of the building. So first we calculate the YP for first 3 years at 10.5% and 5.5%, 10.5% on capital and 5.5% of our reduction. We calculate YP dual rate, which comes out to be 2.4. Then for the next 5 years, sorry, it is for the next 5 years. So for the next 5 years, it will be means YP for 8 years and 3 years we will be using at 11.5% and 5.5%. We will be calculating this YP. This comes out to be 4.66 for 8 years and for 5 years it is 2.4. So the value comes out to be sorry 2.34. So the value comes out to be 2.32. See here the change in value from 2.4 to 2.34 because we have changed this 10.52 and this remains 5.5. So here the value has been increased by 1%. So this value instead of 2.4 this value comes out to be 2.35. So the difference is to 4.66 minus 2.34, 2.34. So this is YP from 8 to sorry from the next means from 3 years to next 5 years mean 3 to 8 years. Then after 8 years, it value we assume it to be perpetual. For assuming it to be perpetual for 12%, so you know for 12% YP is 8.33, and for 8 years the value is 4.66. We have already calculated this as 4.66, so the value is 3.37. So we have three YPs, which is 2.4, 2.32 and 3.37. You add these total YP comes out to be 8.09. So why we have added? Because this net rent is 2,20,000. It remains constant throughout the period. So the value of the portion A comes out to be 17,80,000 approximately. And then for the owner occupied portion, letting value is given to you as 90%. So let us assume 9% as the rate of return. So YP perpetual will comes out to be 11.11 and multiplied with the net rent as 90,000. So the value is 10 lakh. So for the rented portion value is 17 lakh 80,000 and for the tenanted owner occupied portion it is 10 lakh. So the total value is comes out to be 27 lakh 80,000. So other thing which is useful FSI, but what it is given to yet that the title of the land is defective and it is not possible to obtain the permission for constructing the second floor because of proposed widening of the roof. So in other words, usable FSI cannot be utilized and as such whole of the land is enjoyed by the building, and the question of considering available FSI does not arise. So the value of the property comes out to be 27 lakh 80,000. Next, another question, another example. The area of an open plot of land is 40 meter by 30 meter. An area of 200 square meter is to be acquired by the local authorities for the road widening, and owner is expected to be given a compensation of 10 lakh by the local authorities for a within a period of 3 years. The present rate of interest is on the secured amount is 8%. It is given to you. It is also given that the open land is occupied by unauthorized persons. Prevailing market rate of the unencumbered land is rupees 9,600. For the portion occupied by unauthorized persons, high deferment rate of 12% may be adopted. Due to legal entangles, it may take 10 years to vacate the land from unauthorized occupations. Had the property not under unauthorized occupation, how much the owner might have gained? So this thing we have to calculate. See here, amount of compensation is given to just 10 lakhs. So it is to be given within 3 years. So present value. So we will assume that whole of the value or amount will be given after 3 years. So present value of rupees 10 lakh at 3%, sorry 8%. So present value factor is 0.7 lakh. So instead of 10 lakh, its value will be 7 lakh 90,000. So out of 1200, 200 square meter is to be acquired, so remaining portion is 1000 square meters. So the rate is given to you as 9600 per square meters. So 1000 into 900, 600, 9600 per square meter value comes out to be 9,60,000. So it is given that it will take at least 10 years to vacate this property because of unauthorized occupation. So we will defer this value as of 9,60,000 for at 12% for 10 years. So value is 3.222. So we assume that we will be able to revocate this land after 10 years. So the value of the land, present value of the land, which is 9,60,000, it comes out to be multiplying with 0.3322, which is present value factor value comes out to be 3,09,120. So this is the deferred value for the land, remaining portion of the land, and this is the deferred value which of the compensation which he will be getting. So the total value of the property will be adding both of them. So it will be 10,99,120. So had the property been not under unauthorized occupation, so he will be immediately receiving an amount of 9,60,000 and another amount of 7,90,000. So the total value will be 17,50,000. So the owner, how much the owner might have gained? So in this case, if it is not unauthorized occupied, then he will be getting 17,50,000 instead of 10,99,120. So he will be getting a gain of rupees 6,50,880. So we will be considering certain MCQ based upon the calculations which we have done. What is the acquired value of the acquired portion which we have calculated, which is 17,90,000. What is rate may be adopted for unauthorized occupied portion, which we have given to you as rupees 10,000. Which what is the value of unauthorized portion at 9,000 per hundred? We have calculated it as 9,60,000. What is the total value of the property? We have already calculated 17,47,000 approximately. Had the property been not an unauthorized occupation, so we might have got 17,50,000. Had the property not under unauthorized occupation, how much the person might have gained? It is 6,50,880, which we have calculated. Another example, a freehold property having an area of 500 square meter is leased for a period of 50 years, and a period of 15 years have already elapsed. The annual ground rent agreed in the lease document is 1,85,100. The collection and management charges may be taken as rupees 5,05,100. The rate of interest for capital is 8% and redemption is 5%. During this period, the lessee have put up some temporary structures over the land. It is mentioned that the lease document that on the expiry of the lease period, the term of the lease will further be extended for a period of 10 years at the option of lessee. The rate of interest for capital is 9% and 5% during this period. At the end of such extended period, new lease document has to be prepared, but the lease rent will remain the same. For this period, the rate may be assumed at 10%. So this data is given. So here there are three periods. One period is, see here, lease period is 50 years, out of which 15 years have already elapsed. It means he will be getting a rent of 1,85,100 for a period of 35 years. And after that, lease can be renewed for another 10 years. Means from first period, first is for 35 years, then for 35 to 45 years in the second period, and then after 45 years it can be renewed from 45 to perpetual. So in this way we will be getting calculating YP bill for these period for first 35 years, then from 35 to 45 years, then from 45 to perpetual. So we will be applying YP perpetual reversion to perpetual. So YP reversion formula will be used in this question. So income unexpired period for 35 years and for the next 10 years and for the remaining period in perpetuity. Net annual rent, gross rent is given to just 1,85,100. 500,100 will be usual outgoing. So net rent is 1,80,000. So value of the property first case for the lease period of 35 years, which is an unexpired lease period of 35 years. At 8% and 5%, you calculate YP dual rate, which comes out to be 10.98. So the capitalized value comes out to be 10.98 into 1,80,000, 76,400. And then from 35 to 45 years means for the next 10 years, value of the property for YP at 9% and 5% YP dual rate is for 45 years 10.39, and for 35 years YP is at 9% and 5% it is 9.89. So the YP applicable in this period will be 10.39 minus 9.89, which is will be 0.50. So the value 0.5 is YP for this period, and 1,80,000 is the net rent, so the value will be 90,000 for this period. So 1 lakh for the first year it is 19,76,400, and for the next from 35 to 40 years the value is 90,000, and then after 45 years it is perpetual. So let us suppose YP perpetual at 10% is 10, and YP single rate for 45 years, because we have already calculated the value for 45 years. So now we have to calculate the value from 45 to perpetual. So for that we have to deduct the YP for 45 years from the YP perpetual. So the value will be 10 minus 9.86, which is 0.414. So the capitalized value will be 0.14 into 1,80,000, which is 25,200. So the total value is 19,76,400 plus 90,000 plus 25,200. So the total value comes out to be 20,91,600. So we will be discussing certain MCQs based upon this question from the calculations which we have already done. What is the value of the property for the unexpired lease period for 35 years, which we have calculated 19,76,400. Then for the next 10 years means after 35 years, from 35 to 45 years we have calculated YP, which is 0.5. Then value of the property means from 35 to 45 years, which we have calculated as 90,000. Then in the next question, we ask you what is the value of YP to be used For calculating value for the remaining period of in perpetuity after 45 years, we have calculated it to be 0.14, and the value of the property for the remaining period in perpetuity after 45 years we have calculated is 25,200. So total value we have calculated, which is 20,91,600. So these are certain questions based upon income approach, which are very important from your day-to-day work and as well as from examination point of view. Thank you very much for watching this video. Please comment and like on the YouTube channel. Thank you and thanks for watching. Have a nice day.